Hey everybody, thank you for joining us on the self-storage investing for the passive investor. We're going to go through the self-storage asset class, and we're going to talk about a little bit of a market overview this evening, and we're going to talk about the why we like the self-storage asset class, why we've started to focus on that for the last several years, and wrap it up with the real estate syndication process and how to be part of our next passive self-storage opportunity. With that, my name is Ryan Gibson. I'm the Chief Investment Officer for Spartan Investment Group. And with me today, I have Ben Lapidus, who's our Director of Acquisitions for Spartan Investment Group. Ben, are you on?
I am with you. Hello, everybody.
Hey, Ben, why don't you tell us a little bit about yourself?
Sure. Ben Lapidus, Director of Acquisitions and Finance for Spartan Investment Group. I've been an active real estate investing professional since 2012. Currently own 14 single-family homes. At my peak residential, I had over 20 single-family homes and 5 multifamily buildings. But over the last few years, in conjunction with Spartan, have been divesting all of that for the much more desirable commercial assets.
Well, great. Thanks, Ben, and lucky to have you on board. So without further ado, we're going to go ahead and get started. We'll just start with a legal disclaimer that our attorneys require us to throw up. So tonight, anything that we say is just friendly, discussion, and consult with your legal and tax professional. We're not offering advice. Seek outside counsel. This is just a general overview, and information contained is subject to change, and perform your own due diligence. So with that, we'll go ahead and just jump right into who the Spartan team is. On our top left, that's Scott Lewis. He's our CEO and also a project management professional. He's got his PMP certification, big background, and heads up the strategy and operations and the development of our development of our projects. I'm Ryan Gibson. I'm the Chief Investment Officer and the person who organizes the equity for our projects and helps to organize a lot of the permitting activities. Ben Lapidus, who just introduced himself. And then Lindsay Lewis is our Director of Business Intelligence, who does all of our feasibility studies. We provide our feasibility market studies all in-house, and Lindsay leads up that effort. And then we have Jackie Gibson, who's our Director of Operations. So we directly manage all of our own assets and provide all the revenue management, property management directly, and Jackie oversees that part of the company. So a little bit about Spartan. We have $10 million of equity raised through private placement. We have 63 projects underway in the pipeline and 9 completed projects to date. And this is just a little bit about our operating model. We find projects, thanks to Ben, he heads up our acquisition effort, that are either ground up self-storage development opportunities or existing self-storage projects that have a value add component to include the expansion of the facility. Our fund side of it is a combination of private equity and debt raise. So we raise private equity through 506B and 3C syndications and do Reg D offerings. And then we operate the facilities directly, paying out our investors a distribution if the project warrants it, and or doing an equity build depending on if it's a ground up construction or a value add facility. We operate the facility and then eventually we sell. So we're going to just go ahead and jump right into the self-storage asset class, which is the topic of the webinar. And this is just kind of a representation of how the market in general has done for self-storage over the last 20 years or so. And you can kind of see that we've got an S&P all REITs and then self-storage REITs, and you can see sort of the separation of the self-storage REITs performing approximately 3 times better than the average S&P and traditional REITs over the past 20 years. So storage has been a booming industry, and it's been a great asset class to be part of. This is kind of a quote that we really like from Brian Somoza, who's the managing director of JLL Capital Markets. So he says this sector has been recession resistant because the demand for storage space is based on life events such as marriage, divorce, renovating, relocating, etc. So during the Great Recession, self-storage was one of the least foreclosed upon real estate sectors. So we really like this because as the market starts to soften a little bit and some of the residential values go down and interest rates are up and things like that, we like being in an asset class that is a little bit more recession resistant. Nothing is guaranteed, but a little bit more better positioned for a downturn market. So this is kind of the self-storage industry in general. So just kind of a neat comparison to how many locations there are compared to Starbucks, McDonald's, and Burger King. So there's actually more self-storage facilities in the United States than there are store locations of Starbucks, McDonald's, and Burger King combined. There's about 55,000 self-storages in the United States. There's about 16,606 Starbucks as of 2017. A similar amount of McDonald's and just a slightly less amount of Burger King. So if you combine all those together, there's still more self-storages in the United States, which is an interesting fact to just kind of show that Americans, we love our self-storages. So why invest in self-storage? This is kind of the, what kind of drew us to the asset class when we evaluated office, retail, industrial, multifamily, single family, and flipping houses. And these are kind of the reasons that we love self-storage, which at the end of the day, there's low maintenance, no countertops, appliances, cabinets, toilets. It is a very basic slab on grade, typically concrete masonry or metal partition wall with a roll-up door, and there's a lot of benefits from not having all those components within inside those units. The eviction process is very easy. The way the lease agreements that are written in certain markets are so that you have usually about a 30-day window where there can be non-payment, and then the eviction process or the auction process begins because we have a lien against people's belongings when they put it into a storage unit, or we have those lien rights. High occupancy. Right now, the market average is about 94%, so there's a very high occupancy of storage across the United States. Highly automated. We can actually book a unit at our facilities with just the person driving up to the door, seeing a phone number or a website, and either calling the call center or booking through online. And they can book online, pay, sign a lease, get a gate code, move into the unit without talking to anybody, which is a great feature that's not available in every asset class. Simple construction. So usually, like I said earlier, slab on grade buildings are slab on grade with either concrete masonry block, wood construction, or metal construction, which is very quick and easy to put together. And it's not as complicated as other asset classes. And then multiple profit centers. So you can do things like sell propane, PO boxes, merchandise, self-storage units, tenant insurance, and a lot of different ways to sort of make money off of a facility center, depending on the size and location. So why self-storage? So we talked about it a little differently, or a little bit in the beginning, and we talked about how Ben had done multifamily, and he had done some single-family flips. We actually used to be in that business, and the reason why we like self-storage so much is all kind of summarized neatly on the slide. So I think we all get into real estate because real estate generally is more tax advantaged than any other investment opportunity, because you have depreciation, you have deductions, and you have a lot of different opportunities, which is pretty common across single family, multifamily, and self-storage. The one caveat to flipping properties is that's usually subject to the highest taxable rate. So if you're in the flipping business and you're flipping houses without any complicated tax structure, you're usually paying earned income and paying a high rate on the flipping business. Multifamily shares in some of the same building depreciation and cost segregation that you can do in self-storage as well. Average stay, single family homes is the clear winner here, with the average stay at least 3 years for rental, but some comparable stats in self-storage and multifamily. We've found that the average stay in our facility has been well over a year, sometimes longer, and multifamily is a little bit more transient than single family, but still the average stay is pretty good. And then economies of scale. So obviously anybody can scale any business they want to put some strategy behind. But it's a little bit easier to buy one facility with, say, 700 units under one roof, and you can scale that a lot easier than, say, 700 single-family houses all over a certain city or MSA or a part of the country. So we like the ability to scale. Multifamily obviously shares in that same benefit. And then automation is where the self-storage really starts to separate itself from the pack. As I explained earlier, somebody can book a unit without any interaction with anybody, no background, credit, or walking through an apartment or a single family rental. So that's kind of a nice way that this is automated. We can pretty much book a unit completely through the online process. Rent recapture. So if somebody doesn't pay in self-storage, typically after 3 to 5 days, they get red locked. So that means they get a lock over their unit, and they can't access their belongings until they pay. And then after about 30 days, there's a lien process can begin, and we can actually put a lien against their belongings and then put their stuff up for auction, and then actually recapture the rent that we lost, that the occupant didn't pay or owes us, or in the cost of the actual auction process. So in other asset classes, you really just don't have that rent recapture. Usually an eviction process can take as long as 120 days, and it may just mean that you kick the tenant out, but you may not get repaid for all of the rent that you lost while you went through the eviction, and you owe a bunch of money in attorney's fees and all kinds of problems, maybe damage or issues with the unit after they've left, under bad terms. Low maintenance. So we covered that a little bit earlier, but usually these properties are simple construction, very simple HVAC and MEP construction, very basic roofs, slab on grade, easy to use and clean out after a tenant moves in and moves out. It's not like a single family where you've got to repaint, recarpet, retrim, maybe replace some appliances and do a lot of things that the tenant didn't let you know about while they were gone. With storage, it's just an empty box, and when they move out, we sweep the unit and off we go to the next occupant. So we get a lot of questions about kind of who uses self-storage. Is it just Americans with too much stuff, or what's the issue here with storage, and who are your customers? So these are just kind of some examples of our customers. A lot of our customers are general contractors. We have a lot of general contractors and businesses that use the facility, logistic companies, landscaping companies, distributors, college students that are downsizing or moving in between, one apartment to the next, or they're moving out of the dorms and into an apartment. They don't want to move their stuff home for the summer, so they rent maybe part-time. Hobbyists, and we talked about this earlier: relocation, retirees, downsizing, sort of those life events that will never go away. People always relocate, retire, and downsize. So we have these ongoing needs regardless of what the recession or the economy is doing, I should say. Sports teams such as Little League baseball teams, or a business that has equipment that needs to be shared among several people that they don't want to stash in their house. Home renovations that occur when people move out and they get their house renovated. A lot of their stuff goes into storage. Divorce, seasonal equipment, and vehicle storage. So with that, let's give an example of kind of the ideal self-storage facility, and Ben's going to kind of dive into this a little bit as well, a little later in the presentation. But what an ideal self-storage takeover would look like. So this is just kind of a generic example of an existing 20,000 square foot self-storage facility. So we look at that as kind of our minimum acquisition requirement. And let's say we were to look at that facility, and the number one thing that you want to do before you decide to do any self-storage investment is to make sure that the demand is there. So we do a feasibility study, and we make sure that if we build it, people will come. This isn't a build it and hope they will come, or storage is so popular they'll come in any market. You've got to be very careful about where you build and where you expand. And when you write your business plan to take over a facility, it's very important to understand the market demographics. So with that, you've got to have the actual land to expand upon, and the demand. So we have 15,000 square feet, let's say, of allowable expansion. The new, so we build that that additional square footage, and then we have a new facility that's 35,000 square feet in size that has more NOI and more valuation. So we create a lot of value by adding on the addition. So maybe there's some existing cash flow when we buy it, we expand it, now it's a new facility worth a lot more with more cash flow. So that gives us multiple exit strategies. We can cash flow the facility with the new improved cash flow. We can dispose of the facility for a significant equity event. So if we wanted to, if we got a great offer on the facility, we could sell it, or we could refinance the facility into, you know, a 65 or 70% LTV loan and return all the capital that was invested into the facility, you know, from the acquisition standpoint. So there's kind of multiple strategies. And one thing I really wanted to stress is I hear a lot about the buy, rehab, rent, and refinance strategy, where an investor will take a single family home, they'll buy it, they'll renovate it, they'll rent it out, and then refinance it. And what's interesting is usually when you do that, the investor is relying on short-term financing, so 6 to 12 month hard money loan, and they're banking on that property being appraised by an appraiser at the end and getting a 75 or 70% loan to value on their property, and they've got a high interest loan that they put in place in that kind of short-term financing mindset. And if the market changes at all by the time they get to the end, or the property doesn't appraise right, they might have a problem, A, selling the property, or B, getting that loan that goes in place at the end. So what we like about this is we never look at 6 to 12 month financing. We're always looking at at least three, maybe 5 or 7 year financing, sometimes even 10, because we want to make sure that the deal can have multiple strategies. So if we get to the end of this, we're not in a hurry to sell it, or, of course, we're always in a hurry to lease it up, but we have the existing cash flow and the ability to have the property cash flow, even if the market goes down, at least, kind of covering our expenses, so we can sell at the most strategic time instead of having to wait until, instead of having to sell at the wrong time. We want to be able to sell when the market is up. So another kind of last benefit before I turn it over to Ben, who's going to talk about our acquisitions in the market. Purchase price of a storage facility, kind of as a case study, $1.5 million. And obviously, we know that in building depreciation or depreciation in general, we can't depreciate the land. So if you subtract out the land, we have $1.288 million of depreciation that we're allowed to depreciate against. So we do a cost segregation study for all of our facilities that we buy, and the property is broken into 5, 7, and 15-year life. And with the new tax law, you have something called bonus depreciation. So anything that's under that, anything that is short-term life on a property, we can actually take that that depreciation, instead of spreading it out over 5, 7, or 15-year life, we can actually take all that depreciation in year one. So in this case, our study came back and said that we had $352,000 worth of a tax shield, so that any income that's earned, we can shield it against the building depreciation. So in this typical case, and I caveat, check with your CPA, but most of our investors will not pay taxes throughout the course of the investment until the year that we sell. So cash flowing asset, and you get a loss from the building depreciation. So with that, I'm going to go ahead and turn it over to Ben, and he's going to go through industry snapshot, talk about acquisitions, and sort of what Spartan did last year to find the best self-storage investments out there.
Awesome. Thank you, Ryan. So, Ryan's telling everybody out there why we love storage. It's low risk relative to other asset classes in a recession time period. It's higher returns, outperforming the S&P by 300, and it's easy overhead, easy management. So why wouldn't everybody do it? Well, here's where we're at in the industry today. So we're now looking at a $38 billion annual industry revenue. That's more than 5 times what the industry was doing 7 years ago. This says 44,000 to 52,000 storage facilities. There's a lot of different data out there. We've seen as much as 58,000, but we typically roll with the 55,000 number of storage facilities. These two numbers together, with there being also 2 billion total rentable square feet, means that this asset class is the institutional asset class of the industrial niche of real estate. So after multifamily, office, retail, self-storage is the most traded asset class and the most institutionalized asset class. So it doesn't really hold a candle to the multifamily market, but it's still quite large, and there's a lot of really serious institutionalized players playing in this space. So to be able to compete, you have to understand this industry. Some of the metrics that we use to understand them are on the bottom row here. So 7 self-storage square feet per person. On average, if we were to look at the entire nation, the 330 million or so folks in the country, there exists 7 square feet of supply. And right now, at least as of 6 months ago, the physical occupancy of the country was well over 94%, which is about 9% higher than the historical industry average, which indicated that there was a need for more supply. So over the last 3 to 4 years, more supply has come online than the previous 30 years combined, which means that the pendulum is about to swing in the other direction, with there being a little bit too much supply for the existing demand in storage. That being said, almost 10% of all households rent self-storage. So Ryan went through a lot of the folks that rent self-storage. We referred a lot to businesses, hobbyists, people with small businesses, general contractors, or Amazon sellers. But the reality is that 1 in 10 households actually use it for their personal family purposes, whether it's they live in a city and they're super urban and they want to have extra space, or perhaps they are in a state where there aren't any basements, a state like Florida, which is one of the hottest markets for storage. There are no basements in that state, so self-storage is very popular to act as a basement. And for whatever reason, if you were to look to your left and your right and see that 2 people, there's a good chance among the 3 of you that none of you would be renting storage, but the reality is that 1 in 10 households approximately do use storage. And this last stat here is the average self-storage unit rents for about $90. And I believe that is with the average size of around 74 square feet, if I'm remembering correctly, which is up over 15% in the last 3 to 4 years. We've in the last year, we've seen rent growth slow down quite a bit. But prior to that, we were seeing rent growth anywhere from 5 to 9% per year for at least half a decade, if not closer to 7 or 8 years. This last cycle saw one of the largest booms in any asset class in the history of real estate, institutionalized real estate. So that self-storage has had a really successful decade. And while we don't foresee it having as successful as a decade coming forward, we still see it outperforming all other asset classes. Next slide, please. So given all this information, why not go and just kind of compete in self-storage yourself? What is keeping the average Joe or the average real estate investor or the average side hustler from being able to invest in self-storage? Well, anybody can go and buy a deal. Anybody can go and finance a deal. That's not the challenging part. And operating it is, while it has its own set of unique challenges, that's not the unique differentiator that makes a successful group in the self-storage space. These are a list of challenges that we experience on a daily basis that we have gathered an expertise in and that we'd love to share with you so that you can be aware of the expertise needed to be successful in finding the right deals, not just a deal, but the right deal. So I mentioned that the pendulum is swinging in the other direction with more storage being built in the last 3 to 4 years than the prior 30. That means that the market has become grossly oversupplied. We've actually seen in some markets rents starting to decline after this amazing 5 to 10 years of massive growth. And that's because of just the extreme amount of supply that's come online. Now, we don't think that that supply is going to necessarily dry up and shrivel up and die. We believe the demand will catch up. Perhaps there will be some foreclosures in the future. But for right now, it's a very dangerous time to just be buying any self-storage facility. You have to have an expertise in assessing your feasibility, which is the 4th one down on this list. Your ability to actually capture customers, to increase your rent, to continue to operate despite potential additional supply coming down the pipeline. So as part of our process, we're looking for all of the competitive supply that currently exists, all the competitive supply that's coming in the future. We're using linear regression models to extrapolate what the population growth, income growth, and labor growth in a particular intersection in a 1, 2, 3 mile radius or a 5 to 10 minute driving time radius will support as far as the amount of supply. And can our acquisitions, our target acquisitions, not just survive, but thrive in that microcosm of a market? Just because a market such as Tampa might be oversupplied, there are still small pockets, small intersections, or large intersections, but small micro areas that you can be very successful in, despite being in a larger market. And that's because self-storage is a convenient asset class. We're not looking for the 20, 30 minute radius or drive time, 20, 30 mile radius for our market. We're looking at a very microcosmic scale of our market and the immediate households around us. So while Tampa might be oversupplied, this small intersection within Tampa might still be a great deal. Because of this extreme success of self-storage over the last decade, a lot of money has moved into self-storage investing. And some of that money is pretty stupid. And over the last 2 years, if anybody's been tracking what's been going on in the lending environments, the interest rates have been going up. And in theory, trade rates for self-storage should track along those interest rates. And we're just starting now to see that shift. But over the last 2 years, the spread between the trade rates in real estate and the interest rates has been shrinking over time. And that does not make for a successful ownership of self-storage. You can't buy a property unleveraged that produces a 6% return on your investment when you're borrowing the money to buy it at 6%. There's just zero spread there. So knowing what the right price is, despite the fact that everybody else around you might be overbidding, having the calmness to know what is the right price and to not go above that does require an operational expertise. And because 75% of this marketplace is still owned by mom and pop owners, not 75% of the total square footage in the country, but 75% of the actual businesses is still owned by mom and pop folks. Their accounting isn't very good. Their bookkeeping isn't very good. Sometimes they're not always intentionally not representing the actual reality of what it will be like to operate this business and the true expenses, the true revenue, or perhaps they're operating it as a mom and pop facility when you would expect to operate it as an institutional group. And so there's that mismatch there, and being able to dive into all of the financial information and dive into all of the assumptions and work with a seller so that you can suss out what is untrue or what will not transfer over, convey over when you purchase the property is massively important to the success of the purchase. Probably the most difficult thing, though, is being able to predict what is going to happen in the capital markets. As the yield curve changes, as things are happening all around the world, the global economies are in their states of whatever they're doing. Looking and predicting the yield curves within the Treasury, within LIBOR, the WSJ rates, so that you can see 5 years out, what are the interest rates going to be and how does that affect my capitalization rates, which consequently will also affect how much I can sell my business for. Being able to predict the value of your property at disposition is very important to understanding what your overall return is going to be for the project. So keeping an eye on the capital markets requires an expertise. And the last thing I'll point out is development is not an easy thing. We have over 350 points in our due diligence process to make sure we mitigate as much risk as possible. But we're at a state in the cycle where not just with self-storage, but really any asset class, to experience the amazing margins that easily could have been achieved from 2011 through 2015 just by playing the game, regardless of how you did it. Folks were making great margins. To continue to make those margins today, you really have to have a development core competency. Otherwise, you can expect a very depressed return on your investment. Perhaps a stable one, but a very depressed single-digit return on your investment. So these are the market challenges that we're seeing as a company. And what we found is that there's a lot of deals out there. In fact, Ryan, if you can go to the next slide, there's a lot of folks who are seeing that where the values are not what they were 10 years ago, and that this would be a great time to liquidate their investments. So over the course of 2018, you can see how many leads we looked at on a monthly basis, how many we underwrote, how many turned into offers, contracts, and eventually purchases. We looked at over 1,000 properties in 2018, and we purchased 2. We wrote offers on about half a dozen, but we only purchased 2. And that is a result sometimes of just not having the best offer, but more often than not, that was us finding that this was not a deal that was going to pan out to the success standards that we had internally. Now, we think that 2019 is going to be a little bit of an easier year, but it's still going to be tough. And having those expertises and those core competencies, those unique differentiators in your business model to acquire these assets is going to continue to be key. So what we found is, myself as a real estate professional, before being part of a partnership with Ryan and Scott and Lindsay and Jackie, and I'm sure Ryan would say the same thing, it's much easier to compete when you've got multiple heads, multiple professionals working together. So we collaborate instead of compete. And what we found is that our investors think the same way. And that's why we've gone the syndication route to finance these things. So I'm going to actually hand it back over to Ryan to kind of talk about how we collaborate with folks who want to get into storage but don't want to get these core competencies for themselves.
Yeah, it makes sense. And thank you so much for that very comprehensive overview. I really, kind of summarizing it, we kind of look at the $2 to $6 million purchase price, and with that puts us in a space that the average investor can't really go after the property, and the institutional REITs and larger organizations aren't really interested in some of the properties that we're buying that have inefficiencies or sort of have issues that are kind of not worth their time, so to speak. So with syndication, that allows us to pull together private equity and go after this sort of inefficiencies in the market, where we can find a self-storage that maybe has been picked over by a larger institution, but has a lot of niches and inefficiencies that we can come in and take advantage of, set up multiple sources of revenue, optimize maybe other subsidiary businesses that are on the property, such as propane or a car wash or things like that. And we can pool together for larger projects. This allows an investor the opportunity to partner with an experienced operator. And it also allows someone to partner with somebody with development, operations, and disposition experience. And partnership, you're sharing in the tax benefits that the LLC shares down with a limited member. So with these syndications, you get a K1, you're an owner of the LLC, and you share in the equity downfalls or upsides of the investment. So essentially, as everybody probably already knows, there's sophisticated accredited investors. Spartan actually allows both. So you don't have to be accredited to invest with Spartan, but you do have to be sophisticated, and you have to have a prior relationship with Spartan Investment Group, or SIG. And with our assistance, you got to be able to reasonably assess the offering. So it's just kind of common sense stuff. We got to get to know you, and you have to be able to understand the offering that is presented to you. We file this security under the exemption 506B, and then we also do occasionally an accredited investor only offering, not as common, but an accredited investor is a net worth of $1 million, excluding your primary residence, or $200,000 to $300,000 a year in income for single and married filers, respectively. This is offered under 506C, and the big difference here is that we have to do third-party verification of your accreditation, and we have to, and we're allowed to advertise. So most of our offerings are under the left-hand column. So you don't have to be accredited, but you have to be sophisticated and have a pre-existing relationship with one of us at Spartan. So there's two different types of ways to invest, equity and debt. So most of our investment opportunities are on the equity side. You're an owner, sharing the risk, the reward. There's no guarantee, higher return potential, and then you're paid last in the capital stack after debt has been paid. And you're usually paid before the sponsor, which is Spartan Investment Group. So you might get a preferred rate of return or something, but after expenses are paid, equity gets paid next. Debt, we've had some debt offerings where we've raised our own private debt to take down a property that was an unlendable asset. You act as a lender, you're secured by a lien, it's obviously lower risk, it's typically lower return, paid first, most likely as a bank, and a great option for self-directed retirement accounts because you avoid paying the UBTI and the UDFI taxes. And last but not least, this is our investment process. So if you want to become, be put on our list to receive upcoming offerings, you can just simply email me. I'll have an email at the end. You enjoyed our investor list. You receive our offerings as they come out, and you learn more and invest. So when the offering comes out, we'll have a complete offering memorandum, and that will explain the deal, the returns, the timeline, the capital stack, sources and uses. We have a webinar that we take the investor through, so they learn everything about our offering and they can ask questions. And then if you want to do the project, you complete the required paperwork, transfer funds. We put you on the LLC and finalize the corporate documents. And then there's project updates. Our project updates are monthly. So every month you get some type of an update on your specific project that you're invested in. And then we have a quarterly financial review of the project based on revenue, expense, net ordinary income analysis, and distribution analysis. So you can always see how the project is doing based on our pro forma to you, and then also as compared to our actual. And lastly, we do teleconferences every quarter for the project and allow the investors to dial in and ask questions. So with that, we are at the Q&A part of the presentation. So if you guys would like to ask questions, there should be a question drop down on the GoToMeeting, the GoToWebinar, and feel free to ask any questions that you might have. Don't have any questions in the queue right now. Oh, here we go. We have a question in here. Okay, so the question was, for equity investors, do you also provide a preferred rate of return in addition to the equity? Yes, typically, I have to speak very generically about what we offer, but typically we do have a preferred rate of return, yes. And that will be disclosed in the offering memorandum. Sometimes the deal might be structured in a way where we don't, but if it's a takeover, there's typically a preferred rate of return. Great question. All right, any other questions? Any upcoming projects? What's the timeline for offerings? Thanks for your question, Mark. We will. I'll chat with you offline since this is an open, generic, public webinar that is broadcast to the world. I can't advertise specific projects or upcoming solicitations, but I will say that we always have. We're a company that goes out and buys deals, right? So we will always be looking for deals and putting them together and presenting them to you as they come up, and I will touch base with you offline afterwards. Okay. Yes, another good question. Can you give example of previous rates of return for projects for debt positions? I understand they are subject to change. So, I'm looking at the attendees on the call. I don't see anything. Well, it's a public thing, so I can't say it, but I will get back to you on Scott asked the question. I will get back to you after the call, and I will send you our portfolio of projects. So good question, Scott. I can't say it publicly, but I can. If I talk to you individually offline, I can provide that information. No problem. Any other questions? Great questions. right, let's see if we have anything else. Ben, do you have any closing thoughts or things that you wanted to say that maybe that you left out?
No, sir. Not that I can think of, unless you've got a primer for me.
Actually, I got a question. Will you guys be at the Best Ever Conference? Ben, do you know anything about that?
Yes. We actually, when I say we, myself and Joe Fairless from Ashcroft Capital are the hosts of that event. I do not host that event as a representative of Spartan Investment Group. Just want to put that out there. But Spartan Investment Group will be present at the Best Ever Conference. And if there's anybody on the call that's planning on being there, we're very excited to see you. For the folks who don't know what it is a national trade event for experienced non-institutional real estate investors. It's a trade event for the new generation of investors, more or less born out of the 2012 Jobs Act. And we come together once a year to learn from each other, network, party a little bit, and just learn how to grow and scale our business models and find folks to partner with on new deals, whether it's capital or acquisitions or knowledge. It's a great event, 30 plus speakers. There is no selling. There is no funneling into other events. It's just strictly knowledge share. It's a trade event. And if you have any questions about it, you can reach out to either Ryan or myself. And if anybody would like to learn more, you can go to besteverconference.com and use the code SIG, S-I-G, 2019 for a discount.
Awesome, Ben. Yeah, and just a FYI, that's in Denver on February 22nd, 23rd, and we will have Spartan will be attending the event, have a booth. So if you're in the area and you want to check us out, we'll be there. You're also cordially invited to a happy hour if anybody's on this call and you want to join us Saturday night. We have an investor happy hour that we do every year. It's kind of become a nice tradition. And we have it at 5 o'clock on Saturday in Denver at the La Meridian Hotel. And I think with that, we don't have any more questions. And if anybody has anything, feel free to email me. It's up on the screen. And per the questions that I didn't answer on the webinar that I cannot answer publicly, I will send you guys an individual email. Thanks everybody for joining us, and have a great rest of the week and a great weekend.